Hello, my name is Karen Mills, and I'm a member of the DuPage County Bar Association, and I'm also the Continuing Legal Education Chair for the Bar. This webinar is called the Paycheck Protection Program, How to Apply for Loan Forgiveness. And joining me today for this webinar is Brian Eisenmenger. And Brian is a partner at Matheson, Moisky, Austin & Company. They're located here in Wheaton. They're an accounting firm, and they've been helping and serving clients since 1987. They're also affinity members of the DuPage Bar. They're deeply connected to our community here in DuPage County and the people that we all serve, and we appreciate them giving back to all of us today. The next slide is the goals of the webinar. On March 27th of this year, the President signed the Corona Aid, Relief, and Economic Security Act, the CARES Act. And the purpose of that act was to provide emergency assistance and healthcare response for individuals, families, and businesses affected by the pandemic. The United States Small Business Association, the SBA, received funding, and they received the authority through the CARES Act to modify existing loan programs and establish a new program to help small businesses, such as yourselves, that were adversely impacted by the pandemic. Under the CARES Act, the SBA is authorized to guarantee loans under the PPP through June 30th of 2020. On May 15th, the SBA released long-awaited information about how to apply for loan forgiveness. Unfortunately, I think the government did not realize the onerous rules and the burden they were placing on small business owners at a time when we were all trying to figure out how to survive the virus shutdown, and we were cautious in the reopening of our economy. Clearly, it was in the best interest of our economy to make the PPP forgiveness program as simple as possible and seamless for small business owners. And so on June 5th of 2020, earlier this month, President Trump signed a new bill, and that's called the Paycheck Protection Program Flexibility Act, the PPPFA. And that provides more flexibility for business owners that participated in this program, including allowing those participants to defer the payment of certain payroll taxes that the CARES Act prevented them from deferring. The new act reduces the amount of the loan needed to be spent on payroll from 75 to 60%. So this increases the amount of funds that are available for other expenses of the business to 40%. The act extends the window businesses have to use the funds they've received from 8 weeks to 24 weeks. The act pushes back a June 30th deadline to rehire workers to December 31st, 2020. The act also provides more leeway on forgiveness for business owners who show and demonstrate that they cannot rehire workers or reopen due to safety standards. And finally, the act extends the time recipients of the loan have to repay it from 2 years to 5 years. The purpose of this webinar is to give you guidance on how to maximize your PPP loan forgiveness amount. Getting your PPP loan forgiveness boils down to really two things. One, spending your funds on the right things, and two, proving your expenses. Next slide. And so now I'm going to turn it over to Brian, and he's going to introduce our hypothetical business owner right here in DuPage County, who happens to be a member of the DuPage County Bar. Brian?
All right, thank you, Karen. Well, hello, everyone. It's good to be here with you and present this important topic to you. What we're going to do is, just so you know, back on, I think it was about a week ago, today's June 19th, the SBA came out with 2 forms that they have for applying for PPP forgiveness, and that's what everybody wants. And there's some rules changes that took place back on June 5th. And one of the rule changes that took place was that now you need to spend 60% of your PPP funds on payroll. And if you don't spend 60% on, then it becomes a loan that was forgivable over 2 years at 1%, and now it's forgivable at 5 years at 1%. So it's still a good deal if you don't use all of your funds on payroll. The other thing that they did is they came out with two forms: an easy form for those who are self-employed, and a more complicated form. And we are going to go through. I'll show you in a few moments the easy form, but our example today is a more complicated example. And the reason for that is I think you're probably going to be able to figure out the easy form on your own, and we'll go through it with you real quickly regardless. But the other thing change that took place when the SBA made their changes and the government made their changes is that you had before 8 weeks to spend your PPP funds. Well, now you have 24 weeks, and that's going to make this a lot more forgivable. A lot more of the money's forgivable than when it was 8 weeks. Now you've got 24 weeks. So this is our example that we have. We've got Karen. We decided to use Karen Mills, our very own Karen Mills, and she's of course an attorney in Wheaton, and she operates the law office of Karen Mills. So she's got her own business. She's got 2 employees. She's got Jane Rowe, who is an attorney who makes $150,000 a year pre-pandemic. And then she's got John Doe, who's an administrative assistant who made $50,000 per year pre-pandemic. Well, then the pandemic hit. And so, but before the pandemic, both of her employees were full-time, but when the pandemic hit, what she did is that she said for her employee, John, she said, I need to cut your salary, and I'm going to also cut your hours from $50,000 per year down to $30,000 per year. So that's what happened to a lot of businesses. They had to cut salary. Now for the purposes of this, we made Jane Rowe, she continued to work. So, and she continued to work full time, but she did have to cut, and she cut John from $50,000 to $30,000 a year. What Karen did is she applied for a PPP loan, and the amount that she applied for was $40,000, and she received that money on May 1st. So she received $40,000. My guess is if that Karen knew that she had more than 8 weeks to spend the PPP loan, she would have asked for more money. Wouldn't we all have? But we didn't know that at the time. At the time we said it was only given for up to 8 weeks. Now you have 24 weeks to spend the money. So now the funds for Karen, they need to be used by October 15th. That's when they need to be used by. And 60% of the funds have to be used on payroll. So they have to be used for payroll purposes. And then the remaining amount of the funds have to be used on business mortgages, like business mortgage interest payment, business rent or lease payment, and business utilities. Now you might say, well, what does that mean? Well, it's kind of interesting what the government threw in here. For example, business rent isn't just rent for the property, her office spaces that you might have. That might also be her copier lease that she has, or perhaps even an automobile lease that she might have if she uses her automobile for business purposes. So those things can possibly be used. The other one that is business utilities is that business utilities aren't just the gas, heat, electric, water, and whatnot. It also includes cell phone and internet. So she would be able to include her cell phone and internet bills in that on top of her electric and gas. So again, the amounts that are not used for qualifying forgiveness, they have to be paid back over 5 years at an interest rate of 1%, which I still think is a very good deal. They need to be paid back. So the question is, how does Karen qualify for PPP loan forgiveness? Well, the first definition that the government gives us is this idea of a covered period. So the question is what is a covered period? And a covered period is the days including the first day of the PPP loan, so that would include May 1st, that it was distributed, and the first day is the same as the PPP loan disbursement date. So in our example, like I said, the first day is May 1st, and the last day of the covered period for Karen would be October 15th. Now we have Karen doing payroll twice per month. But if she did bi-weekly, which would be 26 pay periods per year or more frequent, the payroll, she would be allowed to use the 24-week or 168-day period that begins on the first day of their first pay period following the PPP loan disbursement date. So if she did payroll every week or once every 2 weeks, she would be able to use this alternative covered period, which again would be the first day of their first pay period following the PPP loan disbursement date. So in our example, we used May 1st and we kept everything easy. But if she maybe had bi-weekly payroll or weekly payroll and the first pay period following the disbursement was May 5th, well then the covered period, the alternative covered period would be from May 5th to October 19th as opposed to May 1st to October 15th. So that's the alternative. And again, you can only do that if you have more frequent payrolls. Now, borrowers who use the alternative payroll covered period have to apply the covered period, alternative covered payroll covered period, that's a mouthful to say, wherever there's a reference in the application to the covered or alternative payroll covered period. However, borrowers have to apply the covered period wherever there's reference to the covered period only. And you'll see that throughout the application, and we'll try to point that out as we go through our example. Now, what are eligible payroll costs? That's come up, and that's been a topic of a lot of discussion. But borrowers are generally eligible for forgiveness for payroll costs and payroll costs incurred during the 24-week covered period or that alternative covered period. And payroll costs are considered paid on the day that paychecks are distributed or the borrower originates an ACH credit transaction. Now, one of the things with regards to what constitute payroll costs is, it's interesting, there's differences for individuals who are employees versus people who are owners or self-employed. So people who are employees, they get things like your health insurance is included in there, as well as retirement. That is not included for people who are self-employed. So that's kind of just one of the nuances that you should be aware of. The other one is that an individual employee, for example, we had Jane Rowe, she made $150,000. Well, the total amount of cash compensation eligible for forgiveness cannot exceed an annual salary of $100,000 as prorated for the covered period. So she wouldn't be able to get forgiveness for any amounts that she paid over $100,000. And again, we talked about this on the leases, but covered mortgage obligations, that includes payment of interest and not including the prepayment of principal on any mortgage obligation on real or personal property incurred before February 15th, 2020. So if you took out a loan for a building, let's say, that you were using after February 15th, 2020, that would not count. However, if you took out a loan before any loans before February 15th, 2020, that would count. Same goes for the rent obligations for business rent and personal property. And then the same is true also of covered utility payments. So the next thing that we want to go to is completing the forms. And before I get into the completing the forms, and we will show you the forms here in just a moment, you need to know there are two types of forms. There's an EZ form and there's the regular form, or what I like to call the not so easy form. So we are going to go through the not so easy form in detail with you, because the easy form is what it is. It's easy. It's not difficult. So let's ask the question, who can use the easy form? Well, first of all, if you're self-employed, if you are an employer who did not reduce salaries or wages by more than 25% and did not reduce the number of hours of employees during the covered period, or employers who experienced a COVID-19 related reduction in business activity as a result of health directives and did not reduce salaries or wages by more than 25%, those would be eligible to use the EZ form. But we have Karen here, and Karen reduced the wages and hours of John Doe from $50,000 to $30,000. So she reduced by more than 25% during that time period. So let me go back. I didn't mean to do that one, but let's go as we if you can bear with me here while I switch slides, and let's go to the here is, can you see that okay, Karen? Just verify with me that you can.
Yeah, if you could just enlarge it a little bit, maybe.
Yeah, I'm going to have a tough time doing that because
Okay.
but anyways, I apologize for that. But this is the easy application, and it is what it is. There's not a whole lot to it. You put the name, the address, the loan number, the number of employees at the time of application, the number at the time of forgiveness, your covered period. So in our case, we would put May 1st to October 15th. And then you would put the payroll costs, the mortgage interest, the lease payments, the utility payments, add those amounts, the PPP loan amount, and you would compare it to make sure that the payroll report costs were 60%, and that's the amount that's forgiven. So there's not a whole lot to this. Let's see, didn't mean to do that. Let's go down here. You have to, you would sign, you would initial and sign these pages here, and then they've got the instructions. They're very easy form to complete. So that this one, if you met the requirements that you saw on that slide previously, you can use this form and there won't be any problem. But Karen didn't meet those requirements. So let's go to Karen's form. And let's see, that is, can you see that, Karen? Probably not.
Not yet.
Not yet. Let's go here. And maybe because I didn't hit share screen. There we go. Can you see it now?
I can see it. Looks great.
Great. Okay, so what we have here, this is the long form. And as you can see, this was just revised on June 16th, 2020. Now, some questions have come up is when does Karen need to complete this form? And I haven't seen, and I apologize, I just haven't seen it out there, any guidance on when it needs to be completed by. So I did what we all should do in these situations, is call our banker who we received the PPP loans from. And what a banker told me yesterday is that this forgiveness application for Karen would be due on October 15th, which I found a bit shocking because she has until October 15th to spend the funds. I would think that you'd be able to do it after October 15th for a time period. But according to him and his understanding is that this would be due October 15th. The bank then has 2 months to process the forms and to request the information, any information that might be necessary. And then after the bank does that, the SBA has 90 days to process. And you know that there's going to be an influx, and so it'll be interesting to see how the SBA and the banks handle the processing of these forms. But what you do is you fill out the form, and actually what you do is you go to the back of the form, and you want to start there. Yes, you can fill out this first part where you've got the SBA loan number, the amount, the distribution date, the number of employees. You can see we've got the amount that's twice a month and the covered period from May 1st to 2020. But then these other amounts, you need to hold off on this first page, and you actually need to go to the back of the form. So that's what I'm going to do here is we are going to go, I think I went too far. You want to go to this page of the form, which is page 4. And what you do here is you take John Doe's name and you take his employer identification number and you say cash compensation. Now I'm going to throw up another slide here, and actually I didn't need to do that. Let me go back here, and I've got the notes here. Cash compensation. So how do we calculate the cash compensation? As you see here on the loan forgiveness, it's $13,846.08. So what you do is you enter the sum of the gross salary, gross wages, gross tips, commissions, etc., for each individual employee. So you do this, and then you prorate it by the covered period. So what I did is I took $30,000 because that is John Doe's salary now. It's been reduced, and we're going to divide it by 52 weeks. That comes up to $576.92, and then we multiply that by 24 weeks, and the 24 weeks gets us to $13,846.08. So that's where we got this number here, that $13,846.08. Then we look at the average full-time equivalent. That is the number here. So let's go back here to our notes and the average full-time equivalent. So what we do with that is we calculate the average full-time equivalency during the covered period or that alternative covered period. And so for each employee, what you do is you enter the average number of hours paid per week. And so we cut John's from working 40 hours a week down to 20 hours a week. And we divide by 40, and then you round to the nearest 10. The maximum that each employee can have, because we know attorneys and whatnot, you guys don't work 40 hours. That's a vacation for you. That is, many of you work more than 40 hours. If you work more than 40 hours, you don't get full-time equivalency and then some. You max out at 1.0. So you would go 1.0, and now you can use simplified method that the government allows, and that's to take 1.0 for employees who work more than 40 hours, and then 0.5 for employees who work fewer hours than 40. But we didn't want to do that in this case. In this case, we wanted to use 0.6 because, again, that's what John Doe is working now. He's working he's 0.6 of a full-time equivalent employee. So then we have to come up with this salary hourly wage reduction. What the heck is that? Well, what we do with that is we come back over here and you have to do this for each employee. In our situation, we've got 2 employees, but you'll have to do this for each employee. And what you do is you first determine if the pay was reduced by more than 25%. Well, we know that it was. So if the pay was less than 25%, then you'd enter 0 there. There was no wage reduction. If the government doesn't count it as such, even though there was. But because in Karen's situation, that the pay was decreased by 40%, then what we have to do is we have to go through these steps. And so the first step, she failed in that one. And then we go to step 2. It says determine the hourly if the safe harbor was met. And what you do is if the safe harbor is met, if 2 conditions apply, and that is that the average annual salary in June 30th is equal to or greater than the average annual salary or hourly wage on February 15th. Well, we haven't hit June 30th yet, but we're going to assume that it hadn't. Or, well, not or, it's and the average salary or hourly wage between February 15th and April 26th was lower than it was on February 15th. So if you meet those 2 conditions, you've met the safe harbor. Otherwise, what you do is you proceed to the next step. So the next step is where it gets a little confusing. And so we've got to deal with it for hourly workers and for salaried employees. So what you do is you determine the difference in the salary wage by subtracting the pay, the employee's pay during the current period from 75% of the pay between January 1st and March 31. And so for hourly workers, what you do is you multiply the calculated difference by the average number of hours per week between January 1st and March 31st. And then you multiply by 24 to get the 24-week equivalent. And if you can use the 8-week if you wanted to, and you'd enter that amount. We didn't do that. We had a salaried employee. So we'll go through the calculation here with how we did it for John Doe. Is what you do is you enter the 24-week equivalent of the difference in the salary by multiplying it by 24 50 seconds, I guess is what you would use. 24 divided by 52, 24 weeks divided by 52 in the year. So you use 8 50 seconds if you use the 8-week period, but we're not. We're going to use the full 24-week period. So what you do is you take $50,000 and multiply it by 75%. So that is 37,500, and then you subtract that by from $30,000. So that's the differential there. So you're allowed to reduce up 25%, but we're doing that differential between the 25 and the 40% that she did, and so that's the $7,500. So you take 50,000, multiply it by 75%, and then take that number, the 37,500, and subtract the annual wage, which is now $30,000. That's $7,500. So you take $7,500 and multiply it by 24 weeks. And that comes to 180, then divide it by 52, and that's your 24 50 seconds. And that comes out to 3,461.54. Now, there are some exceptions to the full-time equivalent reduction, and those are listed here on this page. If you had any employee that you could not hire back, their full-time equivalent can be included here, and they can be included if the position was not filled by a new employee and they meet one of the following conditions. And though there's 4 conditions, you only have to meet one of them. The employee rejected your good faith written offer to rehire them at the same pay rate hours as before. This is important because there are some people out there who they said, you know, I'm making more on unemployment than I'm going to get from my employer, so I'm going to, I'm not going to work. Well, what you need to do if that happened, You need to have a good faith written offer to rehire them at the same pay rate and same hours. So write that down, document it, and that would be an exception. If they were fired for cause, so that would be an exception. If they voluntarily resign, that would be an exception. And then the last one is that they voluntarily requested and received a reduction of their hours. So if that would be an exception, if you meet one of those exceptions, then you wouldn't have to go through all this. But Karen didn't have that situation, so sorry about that. Here we go. So there we have this. Now for Jane, it's very simple. By the way, this first part of the table, there's two parts to this table. The first part of this table is for employees who make their equivalent compensation is less than $100,000 per year, equal to less than $100,000 per year. The second table is for employees who make more than $100,000 per year. Now, one of the things I'd like to point out is you will notice that on these tables, you don't see her name. And that's because it comes back. These are just for the employees, not the employee owners. So just Jane goes here. Now, Jane, the maximum amount we can put for Jane is $46,154. But if we had reduced her hours, reduced and whatnot, we would have to go through the same calculations as before. Now, the next thing we have to do is go through the FTE reduction safe harbor. And so what you would do here is you would enter the total full-time equivalents between February 15th, 2020 and April 26th, 2020. Now, this could be a little bit tricky because you might not have laid someone off until, or not maybe laid someone else off, but maybe not reduced their hours until March 15th. So that's where you have to average it out. And so for our purposes here, we said, and you use the same way that you calculated for the worksheet, we used 1.8. Then for step 2 is you enter the total number of full-time equivalent employees for the pay period, including February 15th, 2020. And if the entry for step 2 is greater than step 1, and it is, 2 is greater than 1.8, you would move on to the next step, and that is how many, what were the borrower's full-time equivalent employees as of the earlier of December 31st, 2020, and the date of this application is submitted, and that would be for Karen, October 15th. So that would be 1.6. So then if the entry for step 4 is greater than or equal to step 2, step 4 is 1.6, step 2 is 2.0, then you would, if it were greater, you'd enter 1, but it doesn't, it's not. And so you don't have the safe harbor. She does not qualify for the safe harbor, but that would come into play. So now that you've completed this part of your worksheet, now you get to go forward. And when you go forward, you go to this is page 3. So what you do is you take, and it's kind of interesting how they did this form. You would think they'd have a line, and all the lines would you take the lines, add them up. It's not how it works. So what they did is they take the line 1, the cash compensation from the worksheet that we just had from table 1 and put 13,846 there. You take the totals for the full-time equivalent, which would be 0.6, and then the hourly wage reduction, which was $3,461.54. Then you go down here and you do the same thing for table 2. And for table 2, you enter the cash compensation and the full-time equivalency as well on line 5, and that's 1.0. Well, that'd be 1.0 because that person was not reduced. Then what you do is you go to line, you do the next line, which is line 6, and you take the total amount paid or incurred by the employer for employer contributions for health insurance. And that again is during the covered period or the alternative payroll covered period. So you would take for our purposes, we said $6,000. So 24 weeks is roughly, it's not quite 6 months, but we said that, let's say that the health insurance was, and this is for the employer contributions for employee health insurance, not for Karen, but for her employees. And the same thing here is we take the total amount paid or incurred by the borrower for employer contributions to the retirement plans. Again, we take 1125 is just the number that we came up with. The next number is for, in Illinois, is not one that we are probably have, and that's for line 8, and that is the total amount paid or incurred by the borrower for state and local taxes assessed on employee compensation. The only thing that might come into play here is state unemployment. So I put this as 0 for our calculation today. But if you paid state unemployment on your employees, that's the number that would go in there. And again, that if you paid it during that time period, so that could be a number. Then what you do is on line 9, you take the total amount paid to owners or self-employed individuals or general partners. That would be guaranteed payments to general partners, and you would include this amount in the PPP Schedule A worksheet. This amount would not be included. I apologize. I'm reading this and I shouldn't have. Don't skip words when you read, but you do not include what you did on table 1 or table 2. Remember what I said before, employers are not included in table 1, table 2 that we did before. And so we have Karen that she makes over $100,000 a year. And so we capped her because we had to at $46,154. Now, we did not include her health insurance. We did not include her retirement plan contributions. Those don't get calculated. But what you do is you take the payroll costs, and what you do is you take lines 1, 4, 6, 7, 8, and 9. 1, 4, so that's 1 year, 13,000, 46, 154, line 4. Line 6, $6,000. Line 7, 1125, and line 9, line 8, line 8 we said was 0, and line 9, which is Karen's compensation, and that totals $113,279.08. Now that you've completed this part of the application, now you can go to the front of the application. And that's where we come back here. And so what we do is, again, it's kind of counterintuitive, but you go to the back and work forward, but we take those total payroll costs, and that was $113,279.08. We didn't have any business mortgage interest payments because Karen leases her building, her office space, and we said that her business lease payment was $2,000 a month. So we said during the time period, 24, we said $12,000. We said that her utilities were $5,000. And again, that would include cell phone, that would include internet. Then what we do is we take that, remember that amount for the salary reduction? We take that and we put this amount here. And that's the $3,461.54. So what we do is we add lines 1, 2, 3, and 4 and subtract line 5, and that brings us to 126,817.54. Then what we do is take the full-time reduction quotient, and this comes from PPP Schedule A, line 13. And we take that and we multiply 126 by 0.8, and that comes up, the potential forgiveness amount is $101,454. But then she only got a loan for $40,000. So we put that amount in line 9, and in line 10, it was, you take the payroll costs and divide by 0.6, and that comes to 188. You take the smallest of those numbers, and whatever is smallest is the amount forgiven. So that is what you do. That is her completed form. Karen had gotten her amounts, her PPP loan completely forgiven. Now it's interesting, you don't know this, but on June 5th, Karen and I did this webinar under the old PPP rules, because PPP forgiveness rules, because they hadn't come out with this. And luckily you didn't see that webinar, because the amount would be wrong. But when we did this for Karen in our example, guess what? She had a portion that was not forgiven. So new rules really are really designed to help small businesses, to help you and me in this situation that most of it will be forgiven. Again, you need to have this completed. Karen would need to have it completed according to the bank that I spoke with by October 15th. That might change. The bank will have 2 months to process it, and the SBA then will have 90 days after that. So that, ladies and gentlemen, is how you complete PPP loan forgiveness. That is a mouthful, wouldn't you say, Karen?
I would, Brian, and I think in closing up here, just remember when you apply for forgiveness, remember to keep the number of full-time employees and an accounting of how the money was spent. Keep track of your payroll documentation for the weeks, the proof of your mortgage payments, proof of rent payments, and proof of utility payments. After you've received your loan and you put it on your books, complete your bookkeeping on all your financial transactions. At the end of the period, 8 to 24 week period, add up that amount spent on forgivable categories and apply for that forgiveness, as Brian just went through, using either the easy form or the not so easy form. And then you submit your request to the bank, and that has to be again submitted by October 15th, 2020. And the bank's going to make a decision within 60 days with regard to that forgiveness. As a borrower, you're going to certify in good faith that because of the economic uncertainty, the loan request was necessary to support your ongoing business operations. And so that's a sigh of relief for small business owners because we don't have to fear an SBA audit, assuming your loan amount was under $2 million. And then you should keep your records. You're required, if you're a borrower, to maintain your records for 6 years after the loan is forgiven or it is paid in full. If you're holding off on applying because you weren't sure about loan forgiveness, the guidance, this new act is good news. And there's money still out there to be had. You have until June 30th to apply for PPP funding. There's also, the SBA recently opened the Economic Injury Disaster Loans application to all businesses again. So that could possibly be another source for our small business owners. And keep in mind, Brian mentioned this earlier, the PPP is a loan and the interest terms are 1%. And now they do not have to be repaid back until 5 years. So that's great terms for a business loan. And so even if there's an amount that may not be forgivable, it's certainly perhaps a good opportunity for your business to borrow money at a low interest rate. Brian, did you have anything else to add?
No, I don't. But again, we're here to help. I know we've got our contact information on the screen to share with you, hopefully hopefully you'll be able to use the easy form. But if you can't, hopefully you've got an understanding of how the more complicated form works. And if we can be of any assistance, we'd love to help.
Our thanks to Brian for participating in this very important webinar. Really appreciate, Brian, the sample forms, and I know the members do as well. Again, please don't hesitate to contact Brian or myself with any questions. We're here to be of assistance. And thank you for listening to this webinar.
Thanks, everyone.